We are pleased to invite in a short moment Mr. Heng Koon, Executive Director and Head of Markets Strategy, Global Economics and Markets Research, UOB, to deliver his keynote address, Asia Pacific in a Fragmenting World. Welcome, sir. Welcome. Thank you so much. Allow me to share a little bit about Mr. Heng as he comes on. Mr. Heng Koon oversees UOB's macro and market strategy with a strong focus on Asia and ASEAN, and is widely regarded for his insights on how global trends and bullion flows shape the region. Over to you, Mr. Heng. Let's give him a big hand.
Thank you. Good morning, everyone. I am very reassured that the room is still half full. So thanks for coming back for the series of keynotes. And good morning, Albert, KL, Trevor, friends from the bullion industry from all across the world. So the brief from Albert to me is very simple. He wants me to give a quick, Bruce, he wants me to give a quick update, right, to the Asian economy, just to update everybody what's happening over the past year. At the same time, have analysis of how, the gold industry, the gold reserves, backdrop is happening across Asia. Now, the good thing is, both do go hand in hand. And there's a very positive, story, positive conclusion to tell. So I'll just go through very quickly a few slides, highlight the obvious, drivers. And then for the next few days, feel free to grab me. We can have discussions, whether you agree or disagree, about where things are going. Now, first up, the so-called the unpleasant stuff. It has been a very, very volatile year since, the start of the Iran war, right? Not just energy prices, practically every other commodity out there, right? Whether it's aluminum, industrial metals, whether it's all the downstream stuff, jet fuel, naphtha, polyethylene, you name it, right? It's volatile. Now, don't look at the numbers. These are normalized return, right, for key commodities over the past, since COVID. The circle on the top left-hand corner is what happened in February 22, when Russia first went into Ukraine, and of course the right-hand circle is right now. And you can see the magnitude, what you call the volatility, the steepness of that volatility that we witnessed this year. So it has been a very difficult situation for a lot of corporates, for a lot of what we call price takers of commodities. Of course, the good news early this morning is that there is now an interim peace deal between US and Iran, which we hope will stick, and that has brought Brent all the way back down incredibly to the low 80s per barrel. So let's hope that drama is over. For those of you who know me, every presentation I'll have one chart which I call the scary chart that frames the whole discussion. Nothing to do with gold, that's the good thing, right? This is the scary chart, right, that frames the whole discussion. The blue line is Brent crude oil, this morning about $84 per barrel now, sub 84. The red line is the world's weighted inflation. Now you can replace it with inflation indices, CPI or PPI from your country, from anywhere in the world, whether it's US, Japan or Singapore. But basically, the red line is going up. The big debate is how bad is this red line? How quick, how fast is it going to go up? Will it be as bad as that spike in 2022? Opinions very divided. We should hear from Kevin Walsh middle of the week how he thinks whether inflation, how bad it will be in the United States. And this is important in a sense for gold. Now, ironically, over the longer run, if you think inflation is now on a higher base, that huge debate about whether inflation should be at 2% or 3 or 4% over the long run, technically, if you think inflation is here to stay and will be a bit more sticky, short-term volatility aside, if you have a 5-10-year horizon, that has to be good for gold and precious metals because, you want something that can preserve against this higher opportunity cost, this higher inflation cost. So I think this is that big uncertainty for a lot of us across the entire bullion industry, for the rest of the year. This is the chart that keeps President Trump awake at night. Right? This is a chart of all your US gasoline prices. Focus on the red line, that's the national average for US gasoline, now about $4 per gallon. It was around $3 before the war started, and it went up to around even $5 for the different grades. Again, that pink line at the bottom, that's US CPI, now above 4%. And again, it's a very sensitive topic for the United States because Trump is going to face higher energy costs or is facing higher energy costs as we head into midterm. How do the voters look when they look at this chart? When the pump prices start to hit is a big question in terms of how midterm is going to work out. Now, so those are all the scary stuff. This is where it gets interesting for Asia. So you would think that inflation is a problem, yes, but here's the good news. This is a chart of key headline inflation numbers across Southeast Asia, whether it's Malaysia, Indonesia, Thailand, and Singapore, right, over the past 20 years. Here's the good news. You notice our inflation indicators are all starting to pick up from the bottom, starting to pick up from the decade's cyclical low. And that's the good news because we may be able to weather this higher inflation risk much more better than the United States or the rest of the world. Of course, we all know that our inflation indicators are low because over the past few years, China has been exporting deflation, right? The cheap goods and services from China, and that's balancing off this risk of higher energy or higher commodity prices. So ironically, that's a plus for all of us in Asia. Now, here's the other good thing. Those of you who are very familiar with Asia will know that we had an incredible year in terms of exports, in terms of trade. If you look at this chart, you can't see the trade war on this chart, literally, right? You can't see tariffs on this chart. Our export indicators literally are going through the roof for practically every other country across Asia, ASEAN, and North Asia. Let me give a few more details. Now, FDI numbers are very strong for our regional countries as well. This is the headline FDI for ASEAN. You notice the big bump above 200 billion after COVID, projected to go above 300 billion, right, by the end of the decade. And again, I'm building the case here, just bear with me, why we need more gold reserves across our part of the world. Remember what I talked about export numbers. This is Singapore's export numbers on the 30-year chart. You can see how incredible it is. Our electronics exports for the latest month jumped 66% for the year. Not 6, not 16, not 26, but 66% for the year. This is Taiwan. Taiwan's GDP grew by 14.5% over the past quarter on the year. That's incredible. And by now you can see a recurring theme. This is all about AI. This is all about semiconductor. And that's the boom that is going through Asia right now for every economy, every industry that's plugged into the semiconductor, into the AI, into the memory boom. And of course, now, you would think in our industry, the gold chart looks remarkable. Now, if I overlay the chart on memory prices over gold, you'll be a bit disappointed about how gold has performed. So this is the price of memory over the past 1 year. It didn't go up by 1 time, 2 times. It went up by 5 or 6 times for all the memory that is basically, in shortage because the AI boom. So, and one more chart for you. South Korea's electronic exports, semiconductor exports, memory exports are up by 200%, nearly 300% on the year in the latest month. So this is important because as the regional exports picked up, the regional countries will need even bigger foreign exchange reserves to basically safeguard, to ring-fence this newfound prosperity against the multipolar world, against all the volatility in policies, whether it's trade coming out of the United States, against volatile currencies and interest rates. And with bigger foreign exchange reserves in the region, obviously, we will need more gold reserves. So that's the running thesis. So moving on to gold next. Again, a few charts to highlight what's happening with gold right now. A lot of investors have asked me, why is gold underperforming, since it topped out around January, right? Again, there's a lot of experts in the room. I will not hazard this time round. I'll be humble. I'll not hazard this time round to put a number to where gold will be. We'll leave it to all of you. But I just want to highlight this observation. So we're trying to crack our head. Why is gold doing badly since February, right? And when you do your maths, basically, if you plot gold with the inverse of Treasury yield, particularly 2-year US Treasury yield, it's a close correlation around 80% on an inverted basis. Basically, Treasury yields go up, gold go down. So your blue line is gold, this morning above 4,003 now, and your red line is 2-year Treasury yield inverted, right? So you can see since 23 to early 26, when Treasury yields on the 2-year dropped from 5 to 3.5%, gold went from 2,000 to above 5,000. So that was that perfect backdrop. Now, this box on the right-hand side is now expanded into this chart. And you can see what went wrong this year. Since February, after the war started, in March, when Treasury yields went up because of inflation concerns about the Fed needing to hike later in the year, you find that as Treasury yields went from 3.5% to 4%, gold went down from around 5.5 all the way to about 4,003 now. So again, just at the risk of oversimplifying everything, the big question is, what will the Fed do? What will US Treasury yields be at the end of the year? That may go in a big way to decide how gold will be, for the next few months. Again, feel free to disagree with me, grab me at, outside for coffee later, and we can have a big discussion on this. Now, this is the other scary chart. A lot of questions about where the Fed is going this year. Your red lines are basically implied Fed fund rates for the end of this year and for the end of next year. Basically, your dark red line is December 26, implied Fed fund rates. Your pink line is December 27. Both around the same. More importantly, both started the year around 3%. So Fed fund rates around 3.75 now. Both started the year around 3. Market expecting 3 cuts this year. That is completely gone now, eroded, normalized to just above 3.75, borderline 4. And again, because of higher energy prices, where market expects a higher, or how should I say, a risk of the Fed hiking rates later this year. Will they or will they not? Remains to be seen. Now, the good news is this. Despite all the volatility, despite uncertainty over interest rates, despite uncertainty over Treasury yield and what the Fed will do, despite all the yo-yo in energy prices, China is one constant. And I've got a lot of my customers asking me, should I buy gold now? Because gold has dropped. My answer, the economist's answer, in an indirect way, is China has always been buying. Right? So if you believe that China continues to load up on gold, right, and it's a long strategic so-called process that's not going to change anytime soon, despite all the noise with the rest of the world, then you would think that gold over the longer run, after this volatility, still has legs. So I like this chart a lot because over the past 10 years, look at the red line. China's portion of gold as reserves, total foreign exchange reserves, went from practically nothing to almost 10% now. And that's a very, very big endeavor despite all the volatility that we have seen. And the latest monthly numbers show that China has been buying gold in May as well. So they have been consistently buying despite all your volatility in gold going higher. The other way to look at this, the amount outside of the sovereign allocation for China, the amount of gold so-called accumulated on the Shanghai Futures Exchange inventory went from practically nothing in late 24 to 120 tons now. That's got to be big. And again, the debate is who is owning this 110, 120 tons, right? Is it the insurance companies? Is it speculators? So on and so forth. But outside of that, you do not see for an exchange that huge amount of accumulation, right, in gold inventory over the past 2 years. So the thesis is that short-term volatility aside, long-term wise, central banks will continue to need to allocate into gold for reserves. And we do see that because post-COVID, on a quarterly basis, so each of these blue bars is a quarter, central banks across the world basically mops up, allocates more than 200 tons per quarter. And if you dwell into the numbers, right, the amount, this 200 tons per quarter, most of it come from EM, most of it come from Asia. So that's where the action is. Now, this is where it's interesting. A lot of questions have been asked about the latest announcement from the ECB about how much gold, so-called, they think global central banks hold. You need to wrap your head around this. So I literally just copied the ECB chart, and text verbatim. Give me a few minutes just to explain this. So if you look at the FT headline numbers, right, it says, ECB says global central banks now own more gold than US Treasuries. That is correct up to a certain point. That is your latest so-called right-hand bar, right, whereby it says that 27% is now gold for global reserves, overtaking US Treasuries, the orange bar in the middle at 22%. But look at the caveat, it says at end 2025 prices. So wrap your head around it. And then ECB basically corrects it and tells us that, okay, if you go back 1 year, based on end 2024 prices, the amount of gold held by global central banks is about 20% of the reserves. If you go back 2 years, end of 23, so I see a bit of disappointed faces, right? End of 23, the amount of gold held by global central banks is 16%. So if you are a cynic, you will say that this jump in gold reserves is basically gold price in dollar terms. You've got to compare everything like to like. All central bank assets are measured in US dollar. And of course, at the same time, the euro depreciated. At the same time, treasuries got sold off, right? Treasury values are much lower than compared to a year ago. And gold prices went ballistic. So in dollar terms, it is true that global central banks own more gold compared to everything else. So again, I'm not putting a dampener to this, but I just want to highlight this little nuance because everybody is saying, as per newspaper headlines, that central banks own more gold than treasuries. It's a half-truth, but I think we are getting there. Now, what we are concerned and what we will be excited about is central banks in Asia owning more gold in tonnage. That's what we're aiming for, today, and that's what we're aiming for in the years later. That, as DPN Gunn says, the connectivity, the so-called the trust in bullion will help grow the reserves across the region further. Now, again, a quick chart on the normalized return of key assets across the world. You see gold is up there, that red line. Over the past 5 years since COVID, gold has returned around 270% and more or less has outperformed S&P, NASDAQ, so on and so forth, MSCI World, and of course treasuries at the bottom. If you have bought 20 years treasuries, you have lost 40% over the past 5 years. And again, somebody told me if you put NVIDIA in this chart, right, then obviously everything else pales in comparison. But that's, the other extreme. Next few charts, concluding charts, I think are the most important one. Some numbers to put things in perspective. And you can see that the global market cap for the equities market is about 150 trillion. give or take 1 or 2 trillion more after SpaceX just went IPO, right? Then you have global debt securities outstanding, 120 trillion. We move from left to right. US market cap should be around 76, 77 now, again, thanks to Mr. Elon Musk. And the amount of treasuries that's been issued is literally borderline 40 trillion. And that's a very scary thought because it is about 120% of the US economy. So that's the reason why central banks need, and it's imperative they must diversify from treasuries into gold, because the value, how should I say, for a lack of a better word, the increasing value destruction from treasuries for central bank reserves is a very, very real risk for sovereign assets. Now, the red box at the right-hand side is what matters most. The amount of gold that's been dug out that is in all the products is around 30 trillion, right? And the amount of gold held in London in LBMA vaults, about 1.3. The amount of gold held on COMEX is about 1.2 trillion. So obviously, in Singapore, it is a much smaller number. And again, the message is not that we aim to take from London or COMEX, right? We aim to grow together. And as remember my earlier numbers about our exports, our industries going very strongly, there's a need to grow our reserves. And so you will see in the years ahead, if we update this chart, you should see more gold being held on a sovereign basis right here in Asia. This is the amount of FX reserves in Asia. Let me explain briefly. So total FX reserves, or central bank reserves in Asia, is about 8 trillion US dollars. Again, put the numbers in perspective, right? $8 trillion is minimal compared to how much equity markets and debt markets are across the world, right? $8 trillion, about 40% is the red bar at the bottom, which is China. The rest of it is the rest of Asia, and India is that, Japan is that orange bar in the middle. So you notice two phases in reserves accumulation across Asia. First phase was between 2000 and 2010. That's the boom years for China after China joined WTO, where trade for China, trade for the region boomed. So huge ramp up in FX reserves for the whole region. Then you have the past decade, a lot of uncertainty, be it COVID, be it trade policies out of the United States, so on and so forth, where FX reserves across Asia went nowhere. Part of it is that Asian governments do spend much more from reserves to basically mitigate the volatility in their underlying currencies. And we all know that the BOJ, the Japanese, are doing their best to make sure the yen doesn't weaken beyond 160. And a lot is literally spent on intervention against yen weakness. In our part of the world, again, stating the very obvious, Indonesia is doing its best to stabilize the rupiah, so on and so forth. But over the longer run, these numbers will go up because we had a very huge export boom. And reserves are basically a function of how big the trade market is, because as exports and trades picked up, we need bigger reserves to make sure your currency, again, for lack of a better word, doesn't come under speculative attack. You need to make sure your region's growth is not imperiled by financial market volatility. So this is a stylized chart basically showing where we are now for gold reserves as a function of total reserves across the region. And again, I'm just giving credit where it's due. This is from the World Gold Council's public numbers, right? It is difficult to calculate the precise amount of gold reserves because part of the numbers are opaque, and the numbers that are reported across different countries can be of different basis. But let's assume this chart gives you a very good picture. So the blue lines at the bottom are all the gold reserves weightage for Asian countries, basically all around 10% of total reserves and starting to pick up. That red line is the world's average, and The yellow line and the orange line is what's happening in Europe. Now again, I would caveat it by sort of, removing the right-hand quarter of the chart, because that big bump is all about gold prices jumping over the past 2 years. But the trend is things are picking up. It's just that it's been very, very exaggerated because gold prices have jumped. So, final chart here for you, and I think that's most important. This is the other way of looking at it. So, the world currently holds about 1/4 of the total reserves adjusted, right, in gold, right? Europe is about half, and again, we all know Europe's gold weightage, right, has not changed at all for the past decade. Europe has started from a very strong high level and has held the same. Now, China, remember what I said, went from 0 to 10%. That's your yellow bar, and that's the benchmark for the rest of Asia. The rest of Asia pretty much hovering below 10. And I would stick my neck out as the most important message for my keynote that by the end of the decade, all Asian countries must hold more than 10% of their reserves in gold. Hopefully, this is from tonnage point of view and not because gold prices are up there, even higher valuation adjusted. But you can see where this is going. For example, India has been ramping up its reserves. And what is not on this chart is this. A lot of the reserves, again, held in US, in New York, or in Europe, has now been diverted gradually back into Asia. India is a prime example. A decade ago, maybe, less than 20%. Now, supposedly, around half of India's gold reserves are back in India. So this is what points to all the key drivers. First, an export boom. Second, a need for more overall reserves for our region. Now, third is this, multipolar, fractured world that basically needs more regional central banks across Asia or ASEAN, right, or our neighbors, to pick up more gold to buffer against that volatility in treasuries. So again, not a very robust analysis, but basically I hope the main points of the long-term drivers are getting through to all of you. And I hope, to hear your thoughts, to pick your brains in the next 2 days. I'll stop here. Thank you very much, everybody.